Good afternoon. We're going to begin the session. My name is Rafael Pinto, and I am the coordinator of the program Eco Challenge for TIC Americas, different inside the program of TIC Americas 2020. We want to thank you for your participation, your patience. The boot camp has been created for several years in the program of TIC Americas to provide training in several business development skills and several opportunities to learn different skills to help your business, following the preparation for your application to the TIC Americas program and Eco Challenge programs and the Caribbean Innovation Competition programs, but also to help keep developing your business as it is. We have a special, and we're very grateful for the participation yet again of Miss Romina Ferreira, who also participated last year as a guest speaker and expert in the boot camp. And she's going to be talking a little bit more about how to prepare, how to set up your financial for your project, for your business, in very simple terms and using very simple tools you can apply, even if you're not a financial expert or have too much background. And we're going to listen to her for about 20 minutes or so and open up the discussion for questions and answer. To ask a question later on, you can there's a little hand signal next to your name on the top. You can also ask questions below. There's a part in the system that you can write your own questions. So we first again thank Ms. Romina. I'm going to read quickly her background. Ms. Romina Valeria Ferreira works at the American Development Bank in Washington, D.C. She is also in strategic planning. She's also works in the strategic planning and development effectiveness division. She's a consultant for that. And she has a master's in finance from the Johns Hopkins University with former work experience, including at the bank's HA and BBVA, both in Argentina and in Asia. So Ms. Romina has a lot of experience and is currently based in DC and really understands a little bit about this world of startups and investment, and all the knowledge experience she can share with us will be very valuable. It is very valuable to the entrepreneurs in our program. So I wanted to give the floor to Ms. Romina. Thank you again for your participation and an opportunity to share your knowledge and with entrepreneurs in our program. I'm just going to unmute you, Romina, please. And you can share your screen. I'm going to take out my screen.
Yeah. Hi, everyone. Can you see my screen right now or not yet?
Yes. I can see it. Thank you, Romina.
Okay. Thank you, Rafael, for the introduction. I'm very happy to be here. And yeah, as Rafael said, this is my second year in the bootcamp, and I do think that this is very important for startups, and it's going to be a little bit of information, very basic information about accounting and about the three statements, and then why are they why this information is important. I'm going to provide an example, and then we're going to go for questions. So yeah, the three statements that we're going to talk about today are the income statements, and I'm going to also talk about the break-even point, how to calculate the break-even point, the balance sheet, and the cash flow. And hopefully after the presentation you can make your own three statements. So first of all, what is a balance sheet? So the balance sheet shows the situation of a business at a specific point in time. So, for example, if we're going to analyze the balance sheet of our business on the 1st of January, it's going to show us how many assets the company has. So the assets are the goods and the rights of the company. Then the liabilities, there are the debts and the other obligations of the company at that point in time, at that 1st of January, and then the equity. So the equity is the owner's capital, so what is the investment that the owners did, and the retained earnings from past operational years. Then what is an income statement? The income statement is a little bit different from the balance sheet in the sense that it shows the performance of the business on a period of time. So it's going to show us the story of the business, for example, in a 1 year period, right? So from January 1st to December 31st. Then the main components of the income statement are the revenues. That's the income generated by the business core operations. Then the cost of goods sold, that's the cost of the raw materials plus the human resources that we're using for producing this product, and other kind of costs that we have, for example, administrative, sales, financial, etc. And finally, what is a cash flow statement? So the cash flow statement is the analysis of where the operation is, the analysis of the cash the operation the company generates, and it's the analysis of whether the operations generate enough cash to sustain the business. We can divide a cash flow statement in three main components. The first one is the operating cash flow, so it's the cash generated by the business core operations. The financing cash flow are those cash flows generated by the financing activities. So, for example, if we have a loan, it's going to be, well, the amount that we are receiving for that loan is going to be in the cash flow, and also it's going to be in the cash flow the repayments of the loan that we are doing. And finally, we have also the investment cash flow. So that's the cash flow generated by investing activities. So in the case that we are buying any machinery, any fixed assets, that's considered investment. So that is going to go for investment cash flow, and as well as the dividend payments that we're going to do to our investors. So yeah, in conclusion, cash flows is an analysis of all the movements that the cash and for saying it wrong, but the money is doing in our company. And why is this so important? Well, this is important for investors because they do their valuation according to the present value of future estimated flows. So we're gonna find at the end of this presentation what are the free cash flows, what are those flows of money that the company is generating not only for this year but for the future years, and we are going to see how to evaluate our company, how to give a number of how much our company is worth. Then investors can also do valuation by multiples compared to similar companies. So these tools are helpful for investors and even for the owners to be able to compare their own business to similar business. And to see if, for example, they're having similar ratios, if they're not performing as well, etc. And then finally, the ratios also help the investors to see trends in profitability and efficiency. For example, investors are going to see what is the net profit margin that the company is generating and how it has been and how it has changed over the years, to see if the company is becoming more efficient or if it's not becoming efficient at all. And also other kind of ratios, for example, the amount of time that the company uses to sell all the inventories, also to see how efficient the company is, and etc. So for the creditors, it's also important because creditors are going to do liquidity analysis and solvency analysis. So they're going to see if the company is generating enough cash to pay their debt, and it's also going to see if the company has enough assets to back up their debt in the case that the company becomes non-solvent anymore, that they go bankrupt, and then they have to check that the company that they're giving loans has enough assets to recover that loan that they give. And then finally, it's also very helpful for you, for the managers, because it helps for operational analysis, to see performance ratios, the ones that I was also mentioning for the investors, so to see if our sales are improving, if our costs are becoming higher or not, and then to do some financial planning. And that's something that specifically I've been focusing about in my career, and that's to plan in the future years if there is some big kind of event, let's say, of cash outflow. For example, we have to buy new equipment in 3 years, and we know that that's going to take a lot of our cash, and then how to plan that accordingly is very important. So when the moment comes, you're not in chaos, let's say. And then also, yeah, again, efficiency analysis. So to see if your net profit is if the margins are improving, if not, and other kinds of ratios that help you see whether you are becoming more efficient, or if you need to help and if you need to work in, for example, selling your inventory faster, or other kinds of efficiency that might be needed. So let's go to an example. So we're going to start by calculating what are your fixed costs. So first of here in this simple chart, I put what are my wages, what is my PP and equipment. This is property, plant, and equipment. So any big machines that I was saying that you might need. Then any marketing costs that you might have in that year. Oh yeah, these are fixed costs for an entire year. And then services, for example, if you need to pay accounting, legal, and the different costs, other costs that you might have. And these are called fixed costs. Yesterday we got the question of what was the difference between fixed cost and variable cost. And for example, for a service, for a company that is providing services, maybe the fixed costs are not that high. So the definition of fixed costs are those costs that cannot be changed in less than a year. So, for example, you have a big, the property, plant, and equipment is something that you have to buy in that year. It's not that you can stop doing it in that year, because then you cannot be producing. And then variable costs are other kind of inputs that you can change in less than a year unit. So these are variable costs calculated for 1 year of production. So I said that in this example, we are going to produce 20,000 units. And for producing those 20,000 units in 1 year, we have 3 different inputs. But here you can change the input for whatever you're needed. I don't know, if you're producing chairs, that would be wood, I don't know, paintings or something like that. And then we add the total variable cost. So we have the total variable cost, we have the fixed cost, and this is a little average that I like to do. That is to see what are my total variable costs divided by my produced units. So each unit of what I'm producing is going to cost $13.5. And that's just a normal division there. And this is something that I consider very important for startups and for those that are just like entering into the market and trying to find some place in the market. Is because this is a very simple strategy for pricing. So here what we're doing is we are assigning 3 different prices, and we are calculating how many units you have to sell at that price to cover all your costs, your fixed costs and your variable costs. So what you can see here is the sum of the variable cost and fixed cost, and that's divided by the price that you're assigning. So what this is telling me is that in 1 year I have to sell 18,153 units to be able to cover all my costs, fixed and variable costs. And this is my profit margin, but it's only taking into account the variable costs. So this is not my net profit margin, but that's the one that's going to take also into account the fixed cost. And the reason why this is not the net profit margin is because of the definition of break-even. Net profit margin would be 0, right? Because as I just said, the break-even point is where is how many units you need to sell in order to cover all your costs. Okay, so now we go to the 3 statements. First of all, we are going to put all our assumptions for the next year. So we are saying depreciation is an accounting concept that what it accounts for is for the cost of using a fixed asset over the years. So for example, if I buy a printer, I have the cost of buying the printer at day 1, right? And then I get the asset. But if I use it for 5 years, at the time that I sell that asset, the input of money I'm going to have is going to be considerably less than the one when I just bought it, right? Because it's used, and then people are not going to pay the exact same amount of money that I paid at 5 years ago. So this depreciation concept, what helps us do is to assign that cost of using the printer for every single year. And it's also helpful because it adds as a cost. So when we pay taxes, they're going to be lower. They're going to account for the reality that we're using our fixed assets. So this, as I said before, this is property, plant, and equipment. So this would be, for example, the printer or whatever machinery you have. Then tax, interest rate. This interest rate is not the interest rate that you are paying. It's the benchmark rate that the investor is going to use to compare your business to other investments they might have. And then we have the revenue. This comes from revenue, cost, and break even. So this is 15 by the amount of this is 15 by the amount of units I'm selling. Then variable costs also is is coming from this side. Then we have other costs that is coming also from here, the total fixed cost. And then, sorry for that, I had to someone got into the room. Okay, so what was I? Okay, so then we have profit margin that is also coming from It's also coming from the other tab. Then interest expenditure is the expenditure that you're gonna pay on your debt. So the amount of interest you're paying on the debt that you got with a bank or with whomever who gave you the loan. And then here's the debt repayment is how many years it's gonna take you to repay that loan. And then here we have some ratios that of which I was talking before, the efficiency ratios. So inventory turnover days is the amount of days that it takes you to sell all your inventory. Then days receivable outstanding is the amount of days that you take to so you sell your product to a client and then you give them some time for them to pay it back. So it's the amount of days that you have before your client pays you back the product. And then days payable outstanding is the amount of days that your input provider gives you before you pay. So it's some kind of short-term loan from your providers. And then something that is very important in this bootcamp is that here we're not only creating the 3 statements for this year, but we're also making the planning, right? So these are inputs for planning. You have revenue growth. How much you think your revenues are going to grow in the next 5 years? And that this is when you're going to tell your investors, right? Like, okay, my revenues are going to grow 30% each year. So this could be an estimate that you make on your market research, or it could be also inflation plus what you think you're going to sell. Then you have the amount of dividends that you're repaying to your client, to your investment. And then the cost growth, right? So your revenues are going to grow, but also your costs are going to grow. Okay, and then here you're going to start putting your revenues. So this is coming from your assumptions here. And then you're going to grow it by this 30% each year. So you're going to do the previous sale times 1 plus this 30%. Then cost of goods sold, it's also coming from the assumptions, which was coming from the previous tab. And then you're going to grow it again by the previous sale times 1 plus 10%. And then we're gonna calculate the gross income, that is this 10% that we had. That it was also coming from the previous tab. We have other costs also from the previous tab, and then we're gonna calculate your net profit, that is the EBITDA. Then we have depreciation. This is the cost that I was talking at the very beginning. And then we're gonna have earnings before interest and tax. You also have to take your interest and your taxes, and you're gonna find your net profit. And after finding your net profit, from that net profit that you obtain, you're gonna give something to investors, right? So you're in this case, we assume that we're gonna give 10%. So these are the 10%, and then this is what you find as return earnings that you're gonna reinvest in the company. Then we have the balance sheet. In the balance sheet, we are using the numbers. For this example, I'm assuming that we already have 1 year of operation. So these 2018 numbers are from the previous year. And then we're saying that we started 2019 with $15,000 in cash. So this is the cash that the company has in the bank or in your house, or I don't know where you're holding the cash. Then we have the accounts receivable. So this is money, what I was saying before, that you sold some items to your clients, but they haven't paid yet. So this started in 2019, you had this amount of money that you still needed to charge from your clients. Then inventories. So these are items that you produce, but you haven't been able to sell. And then you're going to have all your short-term assets. Then long-term assets are, for example, what I was saying before, the property, plant, and equipment, any kind of machinery that you might have. Then we're going to go to debt and equity, right? So everything that you have in your assets was financed somehow, right? So it's either debt, is because you had a loan to pay for those assets, or because you or your investors put some money to pay for those assets. So yeah, so that's it. And then here we're saying that we have $2,000 that we haven't paid to our providers yet. Then we have a short-term debt. So this is the part of the debt that we need to pay this year. And then we have long-term debt as well, which is the part of the debt that we don't need to pay this year, that it's due next year or in 2 years or in the long term. This is your total debt. And then you have shareholders' equity. So this could be your equity. This is the equity that your investors put. The return earnings. So we're saying that this company has been operating for 2 years. So in 2017, they made $1,000. And then this is the total of the shareholders' equity. So we're seeing that this company was financed with 21,000 of shareholders' equity and 7,000 of debt. And finally, we're going to go to the cash flows. We have cash flows from operations. So this is bringing our net profit from before, from the earning statement. Then we have depreciation, because depreciation is not a real cost. There is no cash going out of the company because of the depreciation. It's just this accountant concept, as I explained before. So we need to add it back, because the net profit is assuming that depreciation was a cost where money went out, but here we can see that it was not. And it's the same with the change in account receivable. So if we would have sold all our products in cash, then that would be a cash inflow, right? But here we're saying that if our accounts receivable are growing, that means that we are selling to our clients, but we're not getting any cash yet. So that's why we're gonna take that cash out from our cash flow. And it's the same, but in reverse for accounts payable. So we're saying that we're buying inputs, and our net profit takes that as a cash outflow. But actually, because our accounts payable are growing, we're also not paying our providers yet. So that's why we're going to add that cash, because we still have it in the company. And then changing in inventories is also because we haven't sold those items, so we don't have the cash for those yet. And we don't have any cash flow from investments because we didn't buy any machinery or anything in this year, but we do have cash flows from financing. So we have debt repayment. This is the amount of my principal that I'm paying each year. And then we have dividends. So this is the amount of dividends that I'm giving to my investor. That's the total cash flow from financing, and then we're going to add both the cash flow from operations and the cash flow from financing, and those are our free cash flows for each year. So we started in 2018 with an investment of $20,000 or pesos or whatever, and each year we have this is what the company is generating. And here we're going to calculate the internal rate of return. So this is the return that the company is making on the initial investment. So we're having an internal rate of return on those $20,000 or pesos of 165%, 63%. And the net present value is the calculation of how much is worth our company in dollars or pesos of today. So here is adding a concept that is a little bit different to grasp, difficult to grasp, that is called time value of money. So what this calculation is doing is it discounts every cash flow from every year by an interest rate that we put it in here. That is the opportunity cost of investing in this company for your investors. So we're saying that because your investors are investing in this company, they're missing the opportunity to earn 10% of another investment, right? So taking that opportunity cost into account, this is what your company is worth today. Okay, so I'm gonna go back to the presentation. Okay, so again, the internal rate of return is a geometric average of the expected future returns on investment, and the investor will invest if the IRR is larger than the benchmark rate. So that's what I was saying, that opportunity cost that the investor has. So in this case, it will invest if the IRR is higher than 10%. And then the calculation of the present value of future cash flows originated by an investment, that is the net present value. And the investor will invest if the net present value is over zero, because if it's less than zero, it's saying that you're not recovering your investment. But most likely, it would be investors would invest if it's 2.5 times the investment they did. And this is a little formula to show that the IRR is the interest rate that takes the NPV to be zero. And I put some links here of where you can get more information. So one of them, and my favorite, is Investopedia. You can only find some online courses at Coursera.org or EDX. And finally, at Khan Academy, they have pretty much everything you want, from physics to some finance. So yeah, that's my presentation, and that's my contact information. And yeah, we can go to the questions now.
Thank you so much, Romina. Very clear and direct presentation. It's not always easy to talk about finances or show numbers. I know it's not the easiest of presentation, but it was very clear. Before we open up for questions, I actually want you, all our entrepreneurs in the program, we have entrepreneurs that still their business in their idea stage, or they're starting to put together these pieces, and some that already have traction that use statements, that examples like that you showed. In general terms, what kind of resources? I know you just showed 3 specific sites that they can use and they can learn more as well. But what kind of tools and resources do you think that would be more practical and that you suggest for them to start with, who doesn't have a financial background, they can definitely take a model that you used as an example, and entrepreneurs do need to have these concepts presented, because it's criteria in the TIC Americas program. So perhaps if you can explain a little bit about the tools, what tools do you suggest would be more practical for someone who's just starting to their project and that doesn't have a background too much in finances? Sorry.
Yeah, sure. So, can you hear me or not yet? Sorry.
Yes, we can hear you. Yes.
Oh, okay, perfect. So I don't know what's going on with the slides, but yeah. Okay, so Investopedia, for example, is very helpful for learning more about each concept, but it's not going to. There are no Excels or anything in there that you can download and play around with. However, they are a lot of similar. So what I told everyone yesterday was that if you need, for example, my example, you can email to me and I will send it to you. But also this example is, there are many examples similar to this that are widely available in Google. And even more, if you, that's something that I didn't say yesterday, but if you can find something, for example, if you have a services provider, if your company is a services provider, then maybe you can find a similar Excel, but specifically for services, and that can give you ideas of the accounts that you have to have. So yeah, I'm sorry that I don't have a specific website, but I would recommend to just Google. You can email me and I can send you mine. But also Investopedia is very helpful for understanding the concepts behind this.
No, this is great. Very, very useful. Thanks, Romina. We reminding everyone, if you have a question, you can raise your hand in the little part that has a little hand movement next to your name. You can press that, or you can send it through the questions part. And we do have a question on. Let me read it out for you. Miss Ferreira, can you go over the cost of the NPV and how it affects the cash flow? And can the fixed assets also be? If you want to repeat that again, Romina?
Yeah, I understood that they wanted to go over the NPV and how, yeah. But I lost you at the fixed asset. Like the connection broke. I'm sorry.
No problem. No problem. I can ask again. Go over the concept of the NPV and how it affects the cash flow. That's the first question. Then I'll ask you the second one.
Okay.
How does the NPV affect? Mm-hmm.
Yeah. So it's actually the opposite way. It's the cash flow that affects the NPV. So the cash flow is, what the NPV is calculating is the present value of those cash flows. So how we calculate the cash flow here is how much cash we're going to generate each year, right? So this is in 2019, our company is going to generate $24,277, and so on and so forth. But in that year, right? So this is in 2019 dollars, 2020 dollars, 2021 dollars, and as I mentioned before, this is the concept of time value of money. So what basically the concept says is that those $33,000 in 2020, in 2021, I don't know what it is, 2021, are not worth $33,000 right now at 2019. Why? Because there is an opportunity cost. Like if I get $33,000 in 3 years is not the same that if I get them today, because if I get them today, I can invest them, and in 3 years, I'm probably gonna have more money than that's $33,000, right? So that's that concept, and that is why the NPV discounts each of the cash flows by the discount rate. So what this is doing is dividing this cash flow by 1 plus the discount rate to the amount of years that have passed, right? So this is going to be 1, 2, 3, 4, 5, 6 years. No, 5 years actually, to bring it back to the present value. And actually, we can do it to see. This is going to be 1 plus 10 to 5. And so then here we're seeing that $60,000 in 5 years are the same that receiving $37,000 today. Why? Because if I receive this amount of money, I'm going to invest it, and I'm going to reach to those 60,000 in 5 years. I hope that makes sense.
Thanks so much. I just want to read the Excel that you have there is very practical, I think, for people to use as examples. And when the participants, entrepreneurs apply and upload their doc Americas, let's remember that it's a lot easier to upload an Excel than it is a Word document. The way that Romina's presented it makes it a little bit easier for when the judges look at the projections and so forth. So yeah, it would be great to see this model that you have. People are free to reach out to you. Thank you again for the possibility of sharing this model. Let's see. Just going back to the second question part of that question. Let me see. It was a quick question on, can fixed assets also be machinery? Can machinery be fixed assets? I guess that's the question.
Yeah, exactly. So fixed assets are machinery. That's mainly, yeah, that's the main fixed category of fixed assets. It could also be, yeah, any kind of machinery that you have. Well, there is some kind of gray area on what you consider some office items or fixed assets, but for example, even some computers that if you're programming, if your company is a software, for example, and you need a really good computer, then that could also come into the fixed assets area, right? You're gonna put it into the fixed assets. So yeah, their fixed assets are machinery, are also computers or other kind of assets that you use to produce your final item.
Perfect. No, that's clear. Any asset that's used to produce your service or your product, that's Romina, if you could show your contact information. Do you have that slide again? Sorry.
Yeah.
To share your contact information, please. Thanks so much, and we hope not to bother you so much, but it's very practical and it's very important for this. That's why this is actually the first boot camp topic that we bring up, because it's a topic that's difficult for people to understand. They might not have as much experience, the financial part, but it's really important when you're presenting this to investors and organizing your business. You need to know how this financial flow works. So everybody can see her email, ferreirapeña@gmail.com. Perfect. Let me just see if there's any other questions. Anybody who has a question, you can write it down in the question part below, or the hand button, and I can open your mic as well. If we have any other more questions coming in. Remembering that this session is taped, we'll put it in our boot camp, and you can go back to it and refer to it again. So we'll be sharing this to all the upcoming entrepreneurs that will be signing up in our program as a resource for them to refer to their application process, which is due on the 31st of December. Everybody needs to have all their documents on the platform of techamericas.net. Until now, we don't have any more questions. I don't know if you have any other thoughts, final thoughts, Romina, but I think we don't want to take too much of your time. We thank you again. Do you have final thoughts or encouragements for the entrepreneurs?
Not really. I think I'm trying to think about former questions we might have for those that are gonna watch this once it's online. But yeah, basically my something that I said yesterday was to encourage everyone to submit the 3 statements on an Excel file. You're going to find different templates online. There are some templates that have the 3 different statements in different tabs, for example, and that makes it easier for a real investor to analyze and to see if your assumptions are right, if you think that you're growing at the right pace, and what happens if you grow a little bit slower. So it helps you make some sensitivity analysis as well, and try with the assumptions. What else? Yeah, no, I think that's pretty much it. And of course, you can reach me at my email or find me on LinkedIn, and yeah, I'm available to answer any questions you may have.
Fantastic. Thanks so much, Romina. Again, your commitment and your support to the entrepreneurs all over this program is here, and having experts like you and mentors is what makes also have a high quality and also very helpful for the entrepreneurs to continue growing their businesses. So thank you everyone. Again, we are going to be closing the session, and you can reach out to us if you have any questions, and also to Romina. And good luck in your presentations for the Teach Americas program. Thank you so much, Romina. Have a great day. Thank you, everyone.
Thank you. Bye-bye.
Bye.